这里是解说君的频道。今天我们聚焦全球投资界的传奇人物霍华德·马克斯。作为橡树资本的联合创始人，他不仅在全球资产管理行业享有盛誉，更是华尔街最受推崇的思想家之一。其投资哲学深受本杰明·格雷厄姆和沃伦·巴菲特等价值投资大师的影响，同时又融入了自己对市场周期、风险管理和逆向投资的独到理解。马克思的投资备忘录被全球投资者奉为圭臬，每次发布都会引发市场广泛讨论，甚至连巴菲特也曾公开表示自己第一时间阅读马克思的文章。在本次访谈中，马克思围绕当前宏观经济形势、利率环境、市场周期以及投资者如何在波动中寻找机会等核心话题进行了深入探讨。他的观点不仅涉及全球市场格局的变化，还特别强调了投资心理与市场情绪在决策中的作用。他指出，当前市场正处于一个关键的转折点，投资者需要理解不同经济阶段的特征，才能在长期投资中占据优势。此外，马克思进一步剖析了市场情绪如何驱动资产价格波动，并强调，真正成功的投资者必须在市场狂热时保持冷静，在市场恐慌时敢于逆向而行。这种思维方式不仅体现在他的投资策略中，也反映在他对于风险这一概念的深刻理解上。他认为，投资风险并不仅仅来自市场波动本身，更重要的是投资者如何认知并管理这种风险。也就是说，风险不是由波动率定义的，而是由投资者的行为和市场参与者的预期决定的。值得注意的是，在当前全球经济环境下，利率的变化成为影响市场波动的关键变量。马克思在访谈中详细解读了利率对不同资产类别的影响，特别是债券市场、房地产以及股权投资的变化趋势。他指出，尽管利率上升通常被认为对金融市场构成压力，但真正的挑战在于市场如何消化这些变化，以及投资者如何调整自身的风险偏好。总的来说，这次访谈不仅呈现了霍华德·马克思对当前市场的深刻洞察，也提供了宝贵的投资思考框架。在接下来的内容中，我们将详细拆解他的核心观点，并结合现实案例，探讨这些理念如何指导投资决策。让我们一起进入霍华德·马克思的投资世界。关注本频道，跟我们一起掌握最新动态。
We're going to start the conversation by talking about market cycles. And I just for some stage setting for everybody, and we have a lot of super fans in here of your memos, and many of us who have read a lot of these memos know that there's a couple of things that you always dismiss and a few things that you really believe in. So let me briefly recap that, which is that you don't believe in economic forecasts unless, of course, they come from Goldman Sachs research, then you love them. And you have a quote that you refer to a lot, John Kenneth Galbraith. There are two kinds of forecasters, those who don't know and those who don't know they don't know. And we're going to talk about not knowing stuff later. But while you don't believe in forecasting, you do believe in cycles. And the cycle I wanted to start talking about with you, if it would be okay, is 2008. And the reason I would like to do that is I think it was a very defining moment for Oaktree. And you and your partner, Bruce, the CIO, Bruce Karsh, stepped into the market in a really dramatic way when everybody was running in the opposite direction. And I'll end just by giving people that question, by giving people a sense of the magnitude. Howard and Bruce, in, call it the fall, you'll correct me, of 08, were effectively putting $500 million to work a week in distressed debt, and then a $650 million total a week over 15 weeks across the whole firm. So you were a buyer of $10 billion of assets when everyone was stampeding for the exits. So given that you say that predictions don't work, people might look at that and say, you predicted the global financial crisis. So if you weren't predicting it, what were you doing?
You know, we turned very cautious in the end of 04, 5, 6. And the main reason, I do not believe in forecasts. I believe it's hard to predict the future. It's not that hard to predict the present. In other words, it's not that hard to understand what's going on today. So I do something I call take the temperature of the market. Try to figure out whether the market is heated or frigid. And because you want to buy when other people are pessimistic and when the climate is cold, you don't want to buy when the market is overheated and everybody's optimistic. So the main indicator in 05-06 was, and I always say I wore out the carpet between my office and Bruce's, because I would walk in there a few times a day, and I would say, I'd hold up an article from the news, I said, look at this piece of crap that got issued yesterday. If a company can raise money on this basis, there's something wrong in the market. It's as simple as that, you know? And the market is, you've heard, maybe some of you have heard the term bond vigilantes, but the market is supposed to be like a vigilante. It's supposed to be a disciplinarian. It's supposed to enable good, prudent deals to get done, but not stupid deals. But when anybody can raise money for any purpose or no purpose on any terms, that's a danger signal, and that's what was going on. And it was just getting worse and worse and worse and worse.
And then we got this massive dislocation.
Yes.
Everybody's headed for the exits.
Yeah.
And you stand up and say, bye.
Yes. Well,
how'd that happen?
You know, it really culminated in the bankruptcy of Lehman Brothers on September 15th of 08. We had lost Merrill Lynch and Bear Stearns and Wachovia Bank and Washington, and now Lehman Brothers and AIG. And there was a belief that the whole financial system was going to melt down. And by the way, it did feel that way. It really felt like cascading dominoes. Either the financial system's going to melt down or it's not. If it melts down, it doesn't matter whether we bought or not, because it's, you know, it's game over for everything. But if it doesn't melt down and we didn't buy, then we didn't do our job.
Right.
So let's buy. That was the analysis. I mean, you couldn't say anything more profound than that. First of all, there's really no such thing as analyzing the future, because the future is unknown. But we look to the past for analogies, and this was, you know, there was no analogy to the Lehman bankruptcy, but the past says we have crises and they end. We don't always know how they're going to end in advance, but so we bought, and it was one of the great buying opportunities of all time. And not only could you get good bargains, but you could invest huge quantities. And we were fortunate that Bruce and I had cooked up this idea of developing a reserve fund. So at the beginning of 07, we raised $3.5 billion, which was our fund for that period of time. But we also raised $11 billion, which we put on the shelf, because we thought that something was coming. The first closing was March 07. We didn't start investing it until June 08. We actually had $10 billion to spend, so we were able to spend it.
I want to pivot to talk about another cycle, and you had talked about history can be a guide, and you have a quote I've heard you repeat a lot, which is that history doesn't repeat, but it often rhymes, from Mark Twain. So I want to talk about the tech bubble. So in January 2000, you wrote a memo called Bubble.com, and actually for everybody in this audience, I think it's a really powerful thing to go back and read at this moment in time, because there are a lot of parallels to it. Technology can change the world and not generate a profit. Eventually these companies need to make money, valuation matters, all that good stuff. You have said that that memo, when you wrote, got very wide acceptance, and you've been doing it for 10 years, but you became an overnight success on that. Why is that?
Well, I never had any response in the prior 10 years.
None?
Zero. Nobody even told me they got it. But of course, this was, no, I mean it, but this was the days before the internet. So I mailed them out to a few hundred clients, and they weren't passed around virally like they became.
And you've previously said, when we get to those moments of euphoria, particularly in tech, for example, there's something, people make a narrative that there's something new happening here that history can't discount. So how would you describe that for this one?
You have to have something new, because if you only have old stuff, steel, paper, and chemicals, you know, the history is too well defined and the limitations are too well understood. But if you have something new, that gives flight to the imagination.
Yeah.
And you can say, well, this is, you know, this is something that's going to make everybody rich. And you alluded before to the fact that, so what they said in 98 and 99 was the internet will change the world. And so, by definition, any web grocer is worth infinity. Well, guess what? The internet certainly changed the world, but most of those companies didn't survive because they didn't make money, and they had bad business models and so forth. And what that memo really pointed out more than anything else was how bad the business models were, and they sold on, you know, multiple of eyeballs, you know, because there were no earnings, and in many cases there were no revenues, but you know, so if you have 50,000 eyeballs a day, it's worth such and such. But anyway, you have to have something new. So it could be SPAC, could be SaaS, could be, pardon the expression, Bitcoin. But there's no history to look at, so it's easy to weave a narrative that and there are no historic valuations to limit you and so forth.
You went on to do a career where you lent money to bad companies.
Yes.
People thought were bad, and you made a lot of money doing that.
Yes.
So tell us what that experience was
Well,
like.
I was asked to start a high-yield bond fund in 1978, which was really the beginning of that world. And Mike Milken had this idea that even a crappy company should be able to raise money. You see, prior to 77, 78, it was impossible to do a bond financing for a company rated below investment grade. Mike's idea was that, and it wasn't unique to Mike, that even a crap company should be able to raise money in the bond market if it's willing to pay enough interest to compensate for the risk. And that's what happened. So now, as you say, now I'm investing in the worst public companies in America, according to the ratings, and making money steadily and safely. So I reached two important conclusions. It's not what you buy, it's what you pay. And success in investing doesn't come from buying good things, but from buying things well. And if you don't know the difference, you're in the wrong business, literally. So everything you buy should offer some combination of excellence of quality and or attractive price. You don't want to buy a great company at a terrible price. You don't want to buy, probably don't want to buy something which is horrible fundamentals at a really low seeming price. It's the trade-off that you're looking for.
Last question on the market cycle. So in your first book, you include the Poor Man's Almanac for Investing, and it's a checklist.
Yeah. Well, it's facetious, of course.
Yeah.
Semi-facetious.
So there are some things to look for to see whether your sentiment's negative or positive, and basically if the sentiment's too positive, you want to hold on to your wallet. It's like a quick summary of it.
Yeah.
So do GPs have all the power? Do LPs have all the power? Are the lenders
in negotiating terms of funds?
And then another one was lenders are eager or they're reticent, capital's abundant, capital's scarce.
Right.
Somewhere in the verbiage you put in there that if you're popular at a cocktail party, that's a warning signal that things are too euphoric. But if you go through that, I'm not going to ask you to make predictions, but you think about that framework, we just laid it out here. Where are we in this cycle? Because you said we can know where we are now.
Well, I think we're in moderate territory today, and I have not, some people started calling, bubble 2 years ago, June of 20. I haven't called bubble at all. I think things are high, but not crazy. And I think that valuations have always been reasonable relative to interest rates. It happens that interest rates couldn't stay as low as they were, so valuations have proved to be vulnerable. But I just don't think it's crazy. And now I think that the events of the last 6 months have taken the bloom off the rose. That most of the excesses have been driven out. So, I think reasonable. I was, in thinking about coming here this morning, and you mentioned that I had more correct forecasts than I admit. But the truth is, they weren't forecasts. They were just observations of current conditions. But nevertheless, when I was working on the book about market cycles with my son Andrew, who is a very good professional investor, I said to him, Andrew, I think when I look back, I do admit, I said, I think most of my market calls have been correct. He says, yeah, Dad, that's because you did it 5 times in 50 years. But it was a very profound thing, he said, because 5, 6, 7, whatever it is, times in my career, prices were either here or here. And when prices are at absurd extremes, the logic for a market call is very strong, and the probability of being right is very high. But not when it's here or here, or here or here, or here or here, and that's really the difference.
And we're here?
Well, I think we're here. But the point is, here, prices here have always collapsed, whatever here is defined as. But if I say to you, what's the probability of a decline in 6 months? Here, you might say it's 95. You would never say 100 to anything, in my opinion. But here, it may be 75. And here, it may be 55. And then when you pass intrinsic value, and you're selling below intrinsic, well, what's the probability that next 6 months are up? 55, 75, 95. So, you know, one of the biggest mistakes you can make is to think that overpriced and going down tomorrow are synonymous. Markets that are overpriced often keep going. You know, well, Keynes said it best of anybody. He said markets can remain irrational longer than you can remain solvent. And so somebody who bets that a market which is irrational is going to, a market is too high, we say that's irrational. Somebody who bets heavily that means it's going down tomorrow could lose his shirt or her shirt. Because markets often are overpriced and become more overpriced and more overpriced and more overpriced and more overpriced. That's why we have words like rising market, bull market, bubble. And if it were true that every overpriced market reverts and becomes fairly priced, then we would never get a bubble, because they would stop going up here. But sometimes they go to here and sometimes they go to here. When they get here, the call is pretty safe, especially if you add the word eventually. So what that means is as long as you realize that nothing is sure to happen in this business, every irrationality can be exceeded, that means that you should try to bulletproof your affairs so that it may be likely to happen, but you want to be able to last long enough so that you're around when it happens.
I want to talk a little bit about emotion for a second. And you've said that you need to either be unemotional or act like you are. And I wanted to go actually back to a story you talked about before, which is that this 2008, which a lot of people in this audience weren't here. And I think if you weren't there, you might not appreciate how scary that actually was. I mean, you went through the dominoes of all the banks falling. But were you scared when you and Bruce were putting the capital to work? How did you, or if not, how did you keep yourself from being emotional?
Well, first let me say, if you think about the norm, what happens? Things are going well, the economy is performing well, companies are reporting good earnings, stock prices are rising, everybody's optimistic. And the longer this goes on, people become more and more and more positive, and until they buy here. And when they run out of money, then things turn around. Then eventually the economy weakens, then the corporate profits aren't so good, and stock prices start going down, and people start losing hope. And as this continues, they get more and more depressed and more panicky, and they start fearing further losses until they sell out down here. In other words, they tend to buy more here and sell more here, which is the opposite of what we all should do. My mother said, Howie, buy low, sell high. So emotion is our enemy. Emotion tends to get us to do the wrong thing at the wrong time. And we have to resist that. And one thing I point out is that the influences that affect the crowd and make it do what I just described, those influences are universal. And I feel them too. And you feel them too, and everyone in here. We read the same newspapers. The news is the same for all of us. In order to outperform, by definition, you have to depart from the crowd. You have to hold a different position, and you have to have resolve to do it. And it can't be easy. And I had one of my colleagues came to me in '98. Talking about ancient history, long-term capital had just melted down, and we had the ruble default and the Southeast Asian crisis, and there was a lot of things going wrong. And one of the guys who considers himself to be very thoughtful.
This is at Oaktree, though, right?
Yes, at Oaktree, comes to me and he says, "This is it. I think it's all over. I think the financial system's going to melt down. I think," he explains to me all these things, and I said, "Great, thank you for sharing that with me. Now go back to your desk and do your job." I said, a battlefield hero is not somebody who's unafraid. It's somebody who's afraid, but he does it anyway. I mean, if you're in scary circumstances, to be unafraid, you kind of have to be a nut. But the key is, can you be afraid and do your job anyway?
I was just going to ask you if you thought it helped that you had each other.
Well, I think it's very important that we have each other, and we buck each other up. And And you need that because, what I wanted to say is Dave Swenson, who for 35 years ran the endowment at Yale and did a bang-up job, and he wrote a book called Pioneering Portfolio Management, I think it was in 98 or 9, and he said that successful investing requires the adoption of uncomfortably idiosyncratic positions. Everybody has the same influences. Everybody thinks pretty much the same. Everybody anoints the same winners and criticizes the same losers. And obviously, tomorrow's winners are usually found on the pile of today's losers, not on today's pile of today's winners. But to prospect in today's pile of losers, the things that everybody else are junk, you have to be idiosyncratic. You have to take on idiosyncratic positions. And it's a rare person who can do that and not feel some discomfort. So I think that those two words, uncomfortably idiosyncratic, tell a huge part of the story. But you have to do it. And you have to, when Lehman goes under, you have to buy. You can't sell.
You actually you originally introduced a philosophy or term like you need to dare to be great, and then you evolved that over time, which was more nuanced. Can you walk us through that?
Well, I wrote this memo back in 04, called Dare to be Great, and there was this guy who was really a con man who used to fly around America in a Learjet, and he had these he would drop the stairs and these two vertically challenged people would get off and unroll the red carpet and a big banner that said Dare to be Great, and he would come into some small town and siphon up everybody's money. I forget exactly what the scam was, but anyway, the point is, in order to be a great investor, you have to dare to be great. But then around 2015, I said to myself, but everybody dares to be great. Everybody's willing to be great. But it had come into another focus for me. So I wrote Dare to be Great 2, which I would recommend you read, not 1. And I said, in order to be a great investor, you have to dare to be different, as I just explained. You have to be willing to do some things that are unpopular and by definition will look crazy to others. You have to dare to be wrong, because there's nothing you can do the goal. I think the goal in investing for professionals is to be above average. Investing is a funny business. It's really easy to be average. You just buy an index fund. It's really hard to be above average. But if you want to be above average, everything you do in the interest of being above average exposes you to the risk of being below average. You overweight certain stocks, that's potential error. You avoid certain stocks, that's potential error. You diversify abroad versus the US, that's potential error. You buy high beta stocks, low beta stocks, etc. You hold some cash. There's nothing you can do in the interest of being above average that does not expose you to the risk of being below average. So if you dare to be different, you have to be willing to be wrong.
I want to ask you one follow-up question on that around risk. So, and I actually want to go back to the very first memo you wrote, October 12th, 1990. And I'm going to just quick recap. I might not get it perfectly right, but you had an observation. There was a Midwest pension fund manager who was in the top couple of percentile.
Well, he was in every year for 14 years in a row. He was between the 27th and the 47th percentile, measuring from the top. So he was solidly in the second quartile every year for 14 years in a row. Where did he come out for all 14? Fourth percentile. It's crazy math, because in most walks of life, if you stick between 27 and 47, your average is probably 37. His average was fourth.
So what was the lesson that and there's actually not really any other industry I can think of where you get around median over a long enough time and you're top.
Right.
So what lesson do you take from
Well, and then the reason I wrote the memo, what made me write that first memo, it was the juxtaposition to some guy in New York who was running an investment management firm that had a horrible year because they were a value firm and they bet heavily on the banks, which did it terribly. And so he comes out and he says, if you want to be in the top 5% of money managers, you have to be willing to be in the bottom 5. And my reaction was, I like the first guy better. I like the consistently a little above average as the route to performance, which was the title of the memo. I don't like this idea of shooting for the top and being willing to hit the bottom. I'm not interested in being in the top 5% in any one year. I'm absolutely unwilling to be in the bottom 5%, and my clients feel exactly the same. So why should I do that? We don't swing for the fences. Oaktree does not swing for the fences. Consistent batting average, and what I say is, if you look at the normal distribution read from your direction, most people say, I'm going to get here. I'm going to get into the upper tail. I'm going to shoot for the upper tail. I'm going to swing for the fences. And I'm going to have these huge winners. Our approach is very simple. Cut off the bottom tail. That's what this guy in the Midwest did. Dave Van Benscoten was his name. Cut off the bottom tail. So that if you cut off the bottom tail and your total experience consists of fabulous, excellent, very good, good, not so good, so-so, but never terrible, you'll be one of the best. Not after 1 year. Somebody else will swing for the fences and hit it exactly right and will be lionized for her performance that 1 year. Who can do it for 30 years?
A follow-up question on risk is that you think that there is a subjective judgment is a useful tool in managing risk. I just want to ask you the opposite of that, which is that do you think that there's value in using quantitative tools to measure and manage risk?
No, I really don't. We don't do it at all. First of all, what is risk? It's the probability of a negative event in the future. What do we know about that? What does the past tell us about that? The past has relevance, but it's not absolute. And I think that, and by the way, I was talking about epiphanies before, to digress, if I may.
Yes, you can.
So I was writing a memo in 06 called Risk, and I sat down at the word processor and I wrote what I always believed is that risk cannot be quantified. And that's one of the reasons why I don't believe in models, because risk, being the probability of a bad event, can't be quantified in advance. You can have an opinion, you can state it as a number, but that's not quantification. Quantification is measurement, and the probability of a negative event in the future cannot be measured. And then I wrote something, you hit the carriage return, and for the next section, I wrote something that I never thought of before. Risk cannot be quantified even after the fact. You buy something for $1. A year later, you sell it for $2. Was it risky? Any answers? No, you can't tell. Was it a crazy thing where you got lucky and doubled your money? Or was it a really clever thing that nobody else had figured out where you were sure to double your money? And the answer is you can't tell. No, I don't think risk can be measured. I don't think the past is absolutely applicable. In fact, the big money is lost at the juncture when the past stops being applicable, which happens eventually. And I don't think it can be, I don't think that the possibilities in the future can be synthesized into inputs sufficient to let a computer decide what's risky or not.
I want to just segue to talk about mistakes. So obviously you've gotten a lot right, and we've highlighted all of that. You're also a one-liner, which you're clearly a fan of. I just wanted to share here. Experience is what you get when you don't get what you want.
Right.
When have you ever gotten what you didn't want it, and what'd that look like for you?
Well, when I was starting in my career, I'll never forget, I met this guy, and he says, we're bringing out two new stocks tomorrow. They were both little tech stocks. And he says, and they're both going to double on the first day. I said, good, I'll take it to 100 shares of each. And I called him up the next day, a $10 stock. So I bet 2,000. So I called him the next day. I said, what happened? He says, yeah, they both doubled. I said, good, sell one. He said, what do you mean? They're going to the moon. I said, sell one, and I'll take my money out, and we'll let the other ride. So I sold one. The other one, 40, 60, 80, $100, stopped trading. And there was something crooked. And when it reopened at 25 or something, so I learned that there are no sure things. And if something, it's one of the important parts of being an investor is to be a skeptic. And, if somebody comes to you and says, I've been managing money for 25 years, I've made 11% a year, I've never had a down month. Your job is to say, that's too good to be true, Mr. Madoff. Right? But very few people did. And so I learned the importance of skepticism. And the great thing in life is to learn your lessons inexpensively, as I did.
And one thing that might help someone with that is humility, which is something you're a big fan of.
Yes.
And that's a key cornerstone of our investment culture here.
Yeah, good.
You're also a fan of Peter Bernstein, I believe. And I just wanted to read a quote from him.
Yes.
Humility is an enormously important quality. You can't win without it. Survival in the end is where the winners are by definition. And survival begins with humility. Can you reflect on that a little for us?
Oh, well, that's a great quote from Peter. I have a lot of respect for Peter Bernstein. First of all, it kind of goes without saying, but I'll say it anyway. You can't succeed if you don't survive. And one of my favorite adages is, don't forget the man who was 6 feet tall, who drowned crossing the stream that was 5 feet deep on average. The concept of surviving on average is irrelevant. You have to survive every day, which means really that you have to survive on the bad days. And so that's why I say you have to arrange your affairs, which means your financing or your capital from your investors, whatever it is, or your portfolio, so that you can survive on the bad days. So that's one thing. But humility, it's all about humility. You have to, Dirty Harry said a man has to know his limitations. Mark Twain said that when you know something for certain, you can get into big trouble. It's absolutely the truth. And nothing in our business is certain, and anybody who's certain is really missing the point.
So, and we say something similar to how you say it, which is that we always have to know what we don't know.
Yeah.
And when you and I had that prep call, we competed with each other about how much we knew that we didn't know.
Yeah.
You won because you've been knowing what you didn't know for longer than I'm not knowing what I don't know.
But I wrote 2 memos in the middle of 20, in the middle of the pandemic, in probably June of 20, called Uncertainty and Uncertainty 2, talking about the importance of how uncertain things are, the importance of acknowledging that, especially to yourself. We have to be honest with ourselves. And there's something called intellectual humility, which I think is extremely important. You know what that means, intellectual humility? Very simple. The other person could be right. And if you go into a discussion and say, with the belief that the other person could be right, you're going to have a much more productive discussion.
Do you think, just one last question for you on humility, something we've talked about is sometimes it's harder to be humble when you're losing, actually. When you're winning, you can be humble and it looks very gracious, but when things are working against you, sometimes it can be more difficult.
No, I think
What do you think?
I think it's hard for most people to be humble
At any time.
because they have these defenses that require them to overlook their flaws and their limitations. And so, look, I think that thing about experience is what you got when you didn't get what you wanted. Turn that around. What did you get when you got what you wanted? If you look at human endeavor, I believe strongly that success carries within itself the seeds of failure, and failure carries the seeds of success. What do you learn from success? I can do it. I can do it again. It's easy. I can do it in other fields. I can do it with more money. I can do it alone. It was me. It wasn't the team. And these are horrible lessons. So I think that success teaches terrible lessons because it plays to our egos. And I think you'll learn more from your failures, and hopefully you'll learn humility.
One last question on this is that how do you balance the importance of knowing there's incompleteness of knowledge with the fact that ultimately you have to make some decisions because you're managing people's money?
All these things are about balance. If you assume you know nothing, you can't function. If you think you know everything, you're going to get in trouble. You have to strike a balance, and hopefully it's an appropriate balance. Think about confidence. If you're an investor, if you don't have confidence, then every time you buy something, if it goes down, you're going to sell it because you're afraid it's going to go down more, and you're going to be an abject failure. You have to have confidence. You have to, if you buy something, it goes down, you have to reassess your thesis, and if it's intact, you have to buy more, or you can't be great. But on the other hand, if you have hubris and you feel you can't possibly be wrong, and every time something goes down, you blindly double down, then you're probably going to get into trouble and maybe be asked to leave the industry. So you have to have this balance: confidence, but not overconfidence; humility, but not over-humility.
And then one question for you, just on pushing on this concept of knowing what you don't know. So we have a lot more data now, by definition, than ever in the history of the world. And on one argument, you could say, then that's going to help us know more things, because we can prosecute this data and come to conclusions that we couldn't have otherwise done. We can apply AI, machine learning, get new insights. On the other side, something we say on our team sometimes is a T.S. Eliot quote: where is the wisdom that's lost in knowledge? Where is the knowledge lost in information?
Right.
Where do you fall out on that? Are we smarter?
Look, we have more data, and we have more tools for analyzing the data. But my son and his wife and family came to live with us for the first 3 months of the pandemic, March, April, May of 20. And then he contributed, but I wrote a memo in January of 21 called Something of Value about that experience, because it was a great value for us to live together that time. But he pointed out something very valuable, which was that, Buffett talks about having bought dollars for 50 cents. And he really did, because nobody else knew which end was up, I would say I bought some dollars for 60 cents. I can't find those anymore. And Andrew made the point that readily available quantitative information about the present can't help you be superior as an investor, or it's not sufficient to be superior. You have to work with that stuff, you have to understand it and process it, but it's not enough, because everybody else has it readily available, and it's quantitative, so everybody can process it. And it's about the present, so there's no conjecture, no uncertainty, no vagary. So readily available quantitative information about the present cannot hold the secret to being a superior investor. It has to be something else. And what could those things be? You have to do a better job of understanding the import of those data. You have to do a better job of evaluating the quality of the CEO, the quality of the product, the likelihood that the company will be able to follow a successful product with another successful product, the quality of the accounting, whatever it might be. Or you have to be better at understanding the future. So I wrote a memo called Investing Without People, in which I talked about what will happen with AI and so forth, and machine learning and so forth. And it'll profoundly change our business, and it will put the hacks out of business. But I don't think that it will replace the best investors, because the best investors are the people. I said in the memo, I don't think that a computer can meet 5 executives and figure out which one's the next Steve Jobs. I don't think it can look at 5 business plans and figure out which is the next Amazon. These are subjective judgments about the future, not based on past data. How's the computer going to get the information to make these decisions? Now, what computers do is they handle a lot of data, they handle it fast, they don't make mistakes, they don't make computational mistakes, and they don't make emotional mistakes. So that's a pretty good list. That'll put a lot of people out of business in the investment business, but it will not, in my opinion, enable a computer to be the Warren Buffett of its day, shall we say.
Just picking up on Warren Buffett for a second, he's called, I think, and I might not quote him perfectly, but the discipline you're involved with, the negative art, yes. Because you're just trying to identify ideally the few companies that won't pay you back. So do you ever wish that you lived like in my world of equities, where it was more about possibilities and upside? Is that more fun to you?
You know, I'm an escapee from your world.
Okay. Yeah.
I spent my first 9 years in equity research. I was the director of research at Citibank, and I think that this is better for me, because I'm by nature conservative. And you know, when Buffett says that fixed income investing is a negative art, what he's saying is that bonds don't have upside. They come out at par. They're going to be redeemed at par. So that's the best you can do. It's all downhill from there if you don't weed out the losers. Oaktree's motto is, if we avoid the losers, the winners take care of themselves. But that, when I was asked to start the high yield bond fund in '78 at Citibank, I didn't know it, but it was perfect for me, because it turns my innate conservatism into an advantage. I think that to be in equities, you have to be a dreamer, optimist, and that's not really me. So I think I'm better off this way.
Okay, great. I'm going to end with one kind of, I guess, personal question, which is that you said that there's just to summarize, two important things. You got to know what you don't know, but then you need to know something that other people don't know to make money.
Yeah.
And yet you've been so generous with your time today, all these books you've written, these memos going back to 1990. Why are you telling us all these things you know if we need to not know them for you to make money?
Well, just knowing them is not enough. You also have to implement them, and you know, I think we do a superior job of implementing them. But you know, as I said, this is fun for me, and I've gotten such a great reward from sharing these things with people. You know, the people that I share these things with are not my competitors. They're people. Yeah. And I get these letters saying, you know, you made something complicated clear, or I get letters that say you changed my life. Because there was a prominent economist from the 70s who called me up a few years ago. He said, "You changed my life." I said, "How?" He says, "I don't make forecasts anymore. I tell people what I think is going on, and I tell them what I think the implications are."
Was it Bloom and Doom, one of those economists?
I'm not going to tell you.
Okay.
but I mean, that's so gratifying.
You put him out of business.
No, I improved his business. I made him more valuable to his clients.
By not forecasting.
By not forecasting. And if forecasting is not valuable, then you do a great service to your clients by telling them that.
Okay. I want to pick up on that answer to say that, like, we really are so appreciative of you sharing all of this with investing wisdom with us, and grateful to you for making the time today.
Well, we and I have had a great relationship with Goldman Sachs.
Yeah.
They've been a great help to Oaktree. They took us public. They put us on their True network, and as I told you, they even offered me a job in '77.
Yeah.
解说君备注。总结来看，霍华德·马克斯在这次访谈中不仅重申了自己长期以来对市场周期、风险管理和投资心理的深刻洞察，更在全球经济动荡的背景下提供了一种冷静、理性的投资框架。他强调，市场的波动本质上是由投资者的情绪驱动，而非仅仅受经济基本面决定。因此，理解市场情绪的周期性变化，是投资成功的重要前提。同时，他指出，利率水平的变化不仅影响着资本成本，也在深层次上重塑市场的风险偏好。而当前的高利率环境对投资决策提出了更高的要求。在这样的市场环境下，投资者既不能被短期的市场情绪裹挟，也不能盲目追逐热点，而是要专注于长期价值，把握那些在市场恐慌时被低估的优质资产。这一观点不仅让我们思考，在经济不确定性增加、市场情绪起伏不定的情况下，投资者究竟应该如何调整自己的思维方式？面对波动，应该如何在恐惧与贪婪之间保持冷静？马克思的思考给了我们一个启示，那就是真正的投资智慧，往往体现在逆向思维和对市场周期的深刻理解上。那么，你认为当前的市场处于什么阶段？投资者又应该如何应对？欢迎在评论区分享你的看法，让我们一起探讨。